Today's episode is brought to you by Public.com, an investing platform which you'll be hearing more about later on in the show. But for now, let's get into today's interview. I am joined by Jeff Snider, founder and host of Eurodollar University. Jeff, welcome back to Forward Guidance. How are you doing?
I'm great, Jack. Thanks for having me back. I'm really looking forward to this.
I'm really looking forward to this too, Jeff. You've been worrying about and warning about ongoings in the money market and the yield curve. And things are now, they've reached the next level. And there's a particular idiosyncrasy that is very, very strange going on in the yield curve. So there's really not a better time and not a better guess than you and right now. Tell us what is going on in the short-term interest rate market, why it's so strange, and what you think it indicates.
Well, it's not just strange, Jack. As you know, it's insane right now. The last couple of days have been just completely crazy. But it's not just the last couple of days. We're sort of continuing on from what happened really from the middle of March forward, as SVB and Signature and then Credit Suisse sort of unleashed a tidal wave of shrinking of collateral chains and other types of things, which have just surge in demand for the best quality financial collateral, which happens to be the shortest term Treasury bills. And what we saw yesterday was just an epic buying squeeze. Actually, there was, I think, two of them. One that began early in the morning, hit the 3-month Treasury bill, usual scramble for collateral. You see the bill yields drop in the early morning hours. But then what has become a consistent pattern since mid-March, and I don't really have an explanation for this because this is something brand new. During the U.S. regular session, which is usually when everything is all settled out and fine, ready to go, we've been seeing these absolute epic collateral runs, especially in the 4-week Treasury bill, where the yield just falls off a cliff. And so yesterday we got two of those. Like I said, we had one after the 3-month bill, the regular pattern early in the morning, and then in the early morning of the U.S. regular session, we had about a 20 basis point drop in the 4-week Treasury bill yield, which already, I mean, a couple basis points is enough to get your attention because bills are not supposed to trade all that much. I mean, there's not supposed to be a whole lot of volatility in these instruments. So a couple basis points, you're thinking, okay, something's going on here. 20 is like 2008 territory. And then not only did we get a 20 basis point drop in the bill yields early in the morning, then the auctions came in, the 4-week and 8-week bill auctions, just massive amounts of demand. So it looked like the earlier morning secondary market squeeze in the bills triggered then an even bigger one at the auction. And it just, by one point, I think the 4-week Treasury bill yield was under 3.15%. So down roughly 60, 70 basis points on the day, which again, I mean, a couple basis points is eye-opening. So what is 60 or 70? 60 or 70 is, like I said, it's something that's become more common since the middle of March. And it's something that we saw around 2008 too. So the big drop in bill yields, which indicates there's massive amounts of intraday demand.
And the demand is extreme. You compare it to the 3-month Treasury yield, which is now yielding over 5%, or something like the federal funds rate, which is in high 4%, a little bit less than 5%. So 4.8% you can get just by parking your money at the Fed for the reverse repo, or IOER for Fed funds market. That's between other banks. But these are supposed to be risk-free markets. But then you have a 1-month Treasury bill trading over 100 basis points. I think close to at the low in rates yesterday, 169 basis points below a comparable short-term swap or SOFR, Fed funds, repo, all sorts of alternatives. Why is the market putting such a premium on treasuries? What is so special about them, and what does it indicate to you?
Well, it can't be about the investment characteristics, right? Because you're right, Jack. You go through that menu of alternatives. Any rational human would say, why would I want to own something that only returns about 3% or 3.2% or something like that, when I can get almost exactly the same, in fact, even better in some characteristics, just by rolling over in repo. If I've got spare cash, I could just roll over in GC repo, collateralized by a U.S. Treasury, zero risk, and get closer to 3 or 4.8%. Why on earth would I ever accept even a couple basis points less than that, let alone something like 150 or 170, as you said? Obviously, there has to be some form of value, some kind of value in the specific instrument that has nothing to do with the interest rate characteristic. And of course, the answer to that question or that puzzle is it's Treasury bills, especially the short-term bills, are the highest tier of financial collateral that's used throughout the money marketplace. It is the best of the best collateral. And what you see oftentimes in periods of strain in these collateral streams in the collateral system is that participants in it get herded as lower quality forms of collateral get rejected and revalued and all sorts of bad things. It leads to collateral calls. It leads to some of these chains and collateral chains imploding, which means that essentially everybody gets herded into a narrower and narrower and narrower subset of the marketplace. And since treasury bills are the top part of it, you have this tremendous rush of demand for the best quality collateral because there's other things going on besides what we can see in the T-bill rate.
Right. And let's put this chart up right now. This is the spread between the 1 month Treasury bill yield, which is now very low, minus the Fed funds rate. And the Fed funds rate, when the Federal Reserve talks about what the rate they change, that is sort of the target rate they change. And it is now deeply negative. That large red dot you can see trading about 170 basis points at the peak yesterday. And it really hasn't reached this level since the summer of 2008. And you can see those tiny little red dots there. This is pretty special territory.
Yeah, and I mean, just the rest of the charts too. I mean, look at where the dots are lowest and they're tending to be lower. We correlate those with periods of general money market stress. I mean, look, 2020, you got that one there. Some stuff in 2018 and 2019. We saw lots of strain then. And then, of course, the big one, as I mentioned earlier, and it's right there in your chart, we're seeing stuff in the money markets that we haven't seen really since 2008. This stuff with everything that we see with treasury bills now, the heightened demand for them as collateral, same thing happened, especially in early 2008 around Bear Stearns, and not just before Bear Stearns, but also after, because the Bear Stearns failure actually triggered a whole bunch of aftershocks and after effects, including this generalized scramble for collateral where market participants wanted to make sure that they had their hands on the best stuff because they didn't want to be the next Bear Stearns.
Right. And let's just explore the possibilities of liquidity preference. Treasury bills are preferable. What are the risks of, let's say, a repo entering into repo transaction, so for something like that, that you get 4.9% on, or the Fed funds rate, or the interest on excess reserves for banks, the reverse repo facility, which money market funds now have access to, as well as Treasury bills. What's so wrong about getting, close to 5%? What are the fears there? Because if I can get 5% here, or I can get less than 4%. In order to choose the lower yielding option, I must have some sort of reason why. What is that reason?
Oh, it's even more extreme than that, Jack. Before we get to the reason, I mean, you look at the treasury bill auctions that have been conducted since mid March, and in the 4 week bill auction, four of the last six have produced 0% low yields. In other words, at least 5% of those auctions, 5% of those who were bidding at the auction and were awarded the bid said, I will pay the highest price I can possibly pay just so that I get my hands on these treasury. I will accept zero return, literally zero, nominally zero return. So I have these treasury bills. So, and the reason is because it's not about investments. It's not about choosing a variety of investments for, do I want to put it in GC repo? Do I want to put it into the reverse repo? It's about specifically making sure that you get your hands on that treasury bill instrument. You have to have that instrument in your portfolio, on the asset side of your balance sheet, in order to have that collateral available in case you need it. So it's again, it's not an investment consideration. You have to look at these things as sort of balance sheet tools. And at times of strain like this, the value of those tools just goes through the roof. And because of that, you're willing to pay an extraordinary premium because you have to have these tools. Otherwise, you risk not being able to stay in business.
And you talk about a collateral. So Treasury bill, you can buy it for $97, 90, depending on the term, wherever. Uh, th- um, that can be pledged as collateral for a loan. But what about parking it something in a reverse repo facility or basically having cash? Like, why are the other things not collateral?
Because collateral is
Explain.
fungible. It's
Okay.
fungible in a way that cash never is. I mean, you can think about it. The easiest way to think about it is if you're a money dealer, you want to have as many spare. You want to have the best quality collateral in your inventory because you'll be able to lend it out and relend it to those in the marketplace who are desperate to get their hands on it. Because if you're using lower quality collateral and that's being rejected, you're getting fewer and fewer options. So the value of the higher quality collateral has to go up because it's in such high demand when there's less and less collateral that's available or acceptable on the best kind of terms during these sorts of periods. That's why we associate these low bill yields, high bill prices with
Mhm.
these periods like 2008 or 2020 associated with massive monetary dysfunction because in one sense these are all about collateral squeezes or collateral shortages.
Right. And how is it possible that there's a collateral shortage out there, Jeff, given the immense amount of US government debt that has been issued, given all this money floating around there, which there is a lot of money floating around, how is there a collateral shortage?
There's always, I mean, this is the hardest thing to get your mind around because it sounds like, the government has expanded the amount of US treasuries, so there should be plenty of US treasuries for everybody to use. But the fact is, number one, not all US treasuries trade. We have the distinction between on the run and off the run. And off the run, that was a big problem in March 2020, as we saw. But either way, so we have a smaller subset that's actually liquid. And remember, this is the characteristic that repo counterparties prioritize above everything else. Because if you and I, Jack, get involved in a repo transaction where you're pledging cash and I'm pledging collateral, some kind of collateral, all you care about is the liquidity characteristics of the collateral. Because if I default tomorrow, you have to sell the asset. And so you have to be absolutely 100% assured that tomorrow, if I have to sell that asset, I'm going to be able to get all my money back. Otherwise, you don't want to do the transaction because these are supposed to be as close to risk free as possible. So everything comes down to the liquidity characteristics. But the truth of the matter is, we have this immense, enormous global monetary system denominated in US dollars primarily, and there just isn't enough collateral to go around. For example, if you're a hedge fund, you want to invest in risky securities because you want to enhance your return. You want to leverage up those returns because trading U.S. Treasuries, you're not going to make enough money. You're not going to stay in business. So you invest in a bunch of low quality assets, some junk bonds, let's say, probably emerging market junk bonds. They have high levels of return, and in order for you to leverage that opportunity, you want to you want to fund these transactions in the repo market. But if you go in the repo market with these junk bonds, the repo market's not going to accept your collateral at the best terms. You're not going to get the most leverage that you can possibly get. So what you end up doing is you take these junk bonds and you go to a money dealer and say, I would like to swap these junk bonds for US Treasuries. And the dealer will say, I don't have any US Treasuries, but I know somebody who does. It's usually an insurance company or a pension fund who has a portfolio of these risk-free assets, usually government bonds, that they're only too willing to lend out for a small spread. So essentially, you have your junk bonds. The dealer borrows U.S. Treasuries from a pension fund or insurance company. You all get together, and the next thing you know, you're in the repo market with U.S. Treasuries that technically belong to you, but actually belong to somebody else. So we're already multiplying collateral, and then of course these transactions get even more and more complicated as we go. So the upshot here is that it's never as easy as you think it is. It's not straightforward as you think it is. It's not like parties in the repo market have collateral, they post it, and everything's one to one. You have this constant churn of reusing and repledging, and occasionally rehypothecation, which I know people deny that happens, but we know it does. So there is essentially a collateral multiplier. How many times a piece of collateral might be reused means that a single U.S. Treasury bond might be supporting multiples of these secured financing trades. And it's not just repo, it's not just straight cash. You also have to keep in mind derivatives, which these days is probably more important and more likely to be the cause of the problem than the repo market is. So we have multiples of good quality collateral that it's getting reused. We've got multiples of bad quality collateral gets reused, and just a small reevaluation and revaluation in the bad collateral, because it's multiplied, can lead to a much larger consequence, because the multiplier effect shrinks more than just a single issue or whatever it may be. And so you have this systemic scramble for collateral, where just a little bit of revaluation, some of that junk, triggers this vast need to replace it with good quality collateral in these reuse and repledge chains.
As a bank, you want to own assets. There's securities that has the risks all the way from very short term treasuries, junk bonds, equities, and then there's forms of cash. Cash like securities are those treasuries, but with the cash, there's deposits at other banks, which are the liabilities of them, your asset, as well as deposits at the Fed, which are called reserves. Tell us about those three categories of assets. What are the sort of advantages and disadvantages of them, and why isn't there sort of a scramble to cash? I would think that if everything's going to hell, so to speak, even treasuries wouldn't be worth that much because everyone wants to scramble for cash.
Well, there's always, banks have they have quite a lot of alternatives to manage both the asset side of their balance sheet as well as the liability side of the balance sheet. That's really what we're talking about here. Secured financing transactions are a method of liability management, and it's an effective one. And it's a very complicated one. So individual banks will make individual choices based on whatever liquidity parameters they're facing with. Sometimes that means you want to hold central bank reserves. In the pre-crisis era, where reserves were restricted and there weren't a lot of them, that meant that there was a robust market for reserves. Nowadays, there really isn't, because everybody has access to central bank reserves or some way to get them. But central bank reserves have a very limited, narrow use. In a lot of cases, it's just, I don't want to do anything. I just want to do nothing. I'll just hold liquidity in central bank reserves. It's an alternative to do that. As you said, there's other forms of cash, including deposits with other banks, especially other dealers, which give you a little bit more flexibility in the things that you can do, because the dealer will be able to multiply some of the things that you might want to do depending on what it is you want to do. And then, of course, there's the secured financing transactions, which get you into derivatives and other types of opportunities there. And we have to, derivative transactions like a currency swap, even though it's a derivative, even though it doesn't really go on a balance sheet, it is every bit like a monetary or credit transaction too. So it depends on the balance sheet constraints and the balance sheet parameters that individual institutions, and they don't have to be banks either, it could be non-banks too. What is it they're trying to do at any given moment in time? And as going back to the chart that you showed, Jack, what we see is that during these specific periods, we understand that more and more of these financial participants are being forced to do the same things at the same times because of the systemic conditions. They're being forced to choose pay high levels of premiums for treasury bills, for instance, when there's problems in the collateral marketplace. So they can't replace those problems in the collateral marketplace with something like, for example, central bank cash, because central bank cash, the reserves, or as they call them in Canada, settlement balances, they have a very narrow use. They can't be used in the wider marketplace, except for, if you're settling a transaction in Fedwire or something like that. So it really depends on what's going on in the individual institutions. And then, of course, the systemic properties of the system at any given time that is forcing that many of these individual institutions are forced to respond to.
So, Jeff, we're looking at this chart. I got to be honest, it doesn't look great. Okay, it doesn't look great. The last time this happened was 2008. It doesn't look great. What do you think are the consequences of this?
Yeah, the term that we want to use here is credit crunch, because what happens is when financial firms and even non-financial firms that are caught up in these wholesale market difficulties, what they decide to do is what I call the lessons of Bear Stearns, which was, after Bear Stearns, that didn't represent a success. That represented a systemic rupture, which caused the entire system to stop and say, whoa, wait a minute here. We just had a major failure when we didn't think a failure was really possible. What that means is I can't really depend on the wholesale market system. I can't depend on the Fed. There really isn't a backstop. I'm kind of alone out here, and there's all sorts of risks that I didn't appreciate yesterday. Suddenly, Bear Stearns has focused everyone on the risk and the liquidity risk and the credit risk and everything else, the systemic weaknesses. So, what I need to do is I need to build up my liquidity cushion. And one of the ways I build up my liquidity cushion is make sure I have collateral available just in case, JP Morgan in the old days, now it's Bank of New York Mellon, but in case the tri-party repo custodian knocks on my door and says, I need you to post more collateral. So you build a cash cushion, you build a collateral cushion, which only makes sense, right? If you're concerned about these kinds of things, you want to have that kind of liquidity and insurance if something else continues to go wrong. That's the first thing you do. The second thing you do is you start looking at your assets in your portfolio and think, do I really want to own all of these? Do I really want to be as risky as I was yesterday? Because look what happened to this other firm that wasn't really all that risky. So I start de-risking my portfolio, which includes not just, selling some of the more risky stuff, favoring some of the more safe instruments, but it also means for depository institutions, I don't want to lend as much. I'm not sure I want to lend as much or to the as a wide a variety of borrowers as I was thinking about yesterday. So I'm going to start cutting back on the things I do in the real economy, loans that I make, securities that I buy. So you've got de-risking, which leads to, of course, the credit crunch. And the third thing you do is you hedge. You hedge the hell out of what positions you're left holding, especially if you're left with, if you have a lot of risky assets that are underwater, you can't sell them without creating paper losses, and therefore that leads to all sorts of bad consequences, as we saw with Silicon Valley Bank. So you hedge, you hedge, you hedge, you hedge. And that's something that we saw last month in extreme too, massive swings in hedging instruments. So the lessons of Bear Stearns applied not just to March of 2008, but is I think we're seeing already March of 2023, because we saw, as I said, the hedging that was obvious and immediate everywhere. We've gotten some, obviously we're talking about treasury bills, building collateral cushions, those types of things. So I think that part is, we can see enough of that too. Also, we got the H8 data from the Federal Reserve, and we'll get that updated today, I believe, for last week or this week, where you can see banks all across the US system really built a huge cash cushion. Some of that borrowing from the Fed, the FHLB, some of the other things that they did. And you also have to believe that outside the United States in US dollars, the same thing was going on. But the real big thing as far as the economy is concerned is whether that leads to a severe enough de-risking in terms of loans and just buying securities that it creates the credit crunch that happened in 2008. Or, even a small credit crunch can turn into a really big problem, especially in an economy that is highly dependent upon the constant circulation and introduction of credit.
If you've been listening to Forward Guidance, you probably know that treasury yields have been surging. Right now, you can get a 5.1% yield on your cash with treasury bills. That's pretty good. It's even better than what you can get with a traditional high yield savings account. So owning US treasuries is great, but buying them is super complicated, or at least it was. You used to have to go to a bank or navigate a government website that looked like it was designed in the 90s. Thankfully, investing platform public.com has changed all that with the launch of treasury accounts. Now you can move your cash into US treasuries right from your phone. And you can do it with the flexibility of a bank account. There are no minimum hold periods or settlement delays. In other words, you can access your cash whenever you want. And the best part is that because it's government-backed treasury bills, it's an incredibly safe place to park your cash. Public.com will even automatically reinvest your treasury bills at maturity, so you don't have to do anything to continue growing your yield. So to get that 5.1% yield on your cash, go to public.com/forwardguidance to move your cash into a treasury account today. Thanks, let's get back to the episode. And what are you seeing there, Jeff? We've just had a slew of big banks as well as some regional banks reporting. And I'd say the worst of my fears that I had in March on the deposit fronts of bank runs, my fears have been allayed. It actually looks pretty good. I mean, we'll see going forward. And then on loans, again, you're comparing March 31st to December 31st, and you're not really getting that March sort of out in isolation. So there are other stories to be had, and in particular the beige book. But Jeff, I'll be honest, I don't read the beige book too often. It's not terribly interesting, but I actually did read this one, and I actually got pretty engrossed because there were a lot of fascinating quotes about credit deterioration, and banks are pulling lending. Banks are worried about commercial mortgage-backed securities, and not only worries, but it's already happened for the month of March. So yeah, just elaborate on sort of the credit crunch that you see.
Yeah, a lot of the quarterly statistics, you're not going to get enough granularity about what happened recently. You can look at the weekly H8, which was eye-opening. And the H8, by the way, is the Federal Reserve's. It's a report on what commercial banks, the entire commercial banking system, tells the Federal Reserve it's up to. And there was a lot of stuff in there, especially the final 2 weeks of March, where we saw a massive contraction in lending. I think it was a little about 105 or 110 billion dollars, which is, I mean, again, that's another thing that shows up that's comparable to something like 2008. Bank credit overall restricted by, I think, it contracted by a couple hundred billion, which we had a couple weeks that were just historic levels of contraction. Some of that might have been related to transfers of assets from Silicon Valley Bank and Signature into federal government hands, the receivership. So, I mean, but either way, bank credit contracted and nobody else was out there extending credit to make up for it. So systemically, we had a big credit shock, which, as you alluded to, now we're hearing anecdotes and stories, which is really what the beige book is. That's why nobody, you don't really read this thing except in periods like this, because the beige book is nothing more than stories that regional bank staffs and presidents choose to put into this thing. So it's basically they're curating all the stories they want you to hear from their local contacts. And what you hear in the April beige book, the one that was put out just a couple of days ago, is exactly what you said, Jack. All of a sudden, they're talking about liquidity, tightening credit standards, all these things, looking forward, not looking backward at what happened, saying, you know, it really does sound like the lessons of Bear Stearns I just laid out. That's what you hear throughout the beige book. And interestingly enough, it was the San Francisco branch that probably had the harshest assessment of credit conditions, because that's where the Silicon Valley Bank epicenter was. And what they basically said was credit is already in the process of contracting. And so maybe we don't see it in the current statistics because it takes a while for these things to filter through. But we may see something like that happen early on in April, maybe later, maybe throughout the full month of April. It won't be the same everywhere. So it'll be, some banks will take it as, yeah, we need to really take these lessons to heart. Some banks, some of the bigger banks that have been the beneficiary of the wave of migration deposits, they might say now's a perfect time to take risk, as you mentioned, JP Morgan and some of the other bigger banks. Maybe they'll offset the credit crunch to some extent. We certainly hope they do. I'm not holding my breath on it, but it's always a complex thing. But as you mentioned, we're seeing the liquidity problems, which just simply heighten the reminder that you need to be defensive in these periods, and defensive for the economy overall, defensive measures taken by banks. That's pro-cyclical. So if we already have a struggling economy and then you introduce a credit crunch on top of it, it can turn maybe a mild, it can turn a downturn into a recession. It can turn a mild recession into something much bigger. So we'll see how that plays out. But the initial aftermath of March, I mean, look at Treasury bills, look at the yield curve, look at what banks are saying. You just get this, maybe this does turn out to be what we hope it doesn't.
Right. And how do you make sense of, in October, the big bank CEOs were saying a storm is coming. That's what Jamie Dimon said. And the Fed was saying everything's fine. Now, the Federal Reserve
That's
staff in
typical.
the minutes are saying we expect a recession that will be mild. And in the beige book, it's looking quite grim. And that comes from the Federal Reserve. However, the big banks, they seem pretty sanguine. How do you make sense of that?
Because they ended up being on the good end of this thing, right? The big banks are saying we think everything's fine because for them, everything is fine. That's the key difference here.
Their deposits went up. JP
There's
Morgan, yeah.
several key differences between now and 2008, but that's one of the key differences. In 2008, it was the big dealer banks who were under the spotlight. They're the ones who are under the most pressure. Now they're the ones saying we can step back and just look at everything from above and say, this is not going to be a big deal for us. It might be a big deal for everyone else. But there's also the incentive here where the big banks don't want to be dragged into this thing. So they have every incentive to say, this is no big deal because we don't want to be dragged into it. We want to stay out of it. We're perfectly fine. Don't even question our balance sheet at all. We're good here. Whereas the Fed, the Fed always gets it wrong. The Fed always has to react to events. And you always have to wonder, why don't you people see these things coming? Why don't you ever do something about it before it happens? Why do you always have to create a new tool after all the old tools failed to stem the crisis? So in one sense, it's good that the Fed is finally admitting that hey, there's a possibility of a recession here coming up, and it could get much worse depending upon how this credit crunch develops. If it goes the wrong way, it could get really bad really quickly, and we'll do our best to try to mitigate the fallout. But as far as actually getting ourselves out of, or as far as what the markets are pricing, that's why doesn't the Fed ever take into account yield curves and curves like that instead of always falling back on their DSGE econometric models, which never see these things coming. So, in one sense, that's one reason why we're seeing these, banks building the liquidity cushions and de-risking, because they realize you can't count on the Fed to bail you out, because by the time the Fed realizes it needs to do something, it's already too late. And that's one of the factors that you have to keep in mind in the banking system, is that, again, like in 2008, participants realize they're really isolated and alone out there.
Yeah, it's been interesting to see the Federal Reserve, framework. Jay Powell talking about, oh, in 2023 we're going to have slow growth. To 2023 we're going to have very slow growth, and now the FOMC, not the FOMC, the Federal Reserve staff is expecting a mild recession in 2023. So slow growth to very slow growth to mild recession. What do you think about that term mild? To me, Jeff, to me, it does seem plausible. Yeah, okay, so things will slow down a little bit. The unemployment rate will go up, spending will go down, borrowing will go down, defaults will go down, but then it will be what they call a mid-cycle slowdown, and thankfully, inflation will, consumer price inflation will fall down as well. Where, if you disagree with that, why?
Oh, I disagree with it because it doesn't take into account the real financial fallout. And again, to be fair, the Fed said, our base case, the staff said, as you pointed out, Jack, our base case is a mild recession, which, I mean, it's not good. Let's be honest about it. It's not a good thing, but it's certainly more palatable than the alternative, which they also talked about in their last meeting minutes, which is, if all of the things that the market has been pricing for months actually do play out, we won't get a mild recession, because they even said in the minutes that they basically point blank stated that recessions and downturns that happen at the same time as financial market difficulties and credit crunches lead to the most severe cases. So what the Fed actually said, they actually planted the seed for that. They said, well, we weren't expecting a recession. We were expecting a slowdown, but now we're thinking that it'll be a mild recession and hopefully nothing more than that. But by the way, just keep in mind here, if things do continue to get worse, it won't be a mild recession. So what's actually happened here is the Fed is slowly, incrementally progressing toward the same position that the markets have been in for quite some time, really going back to last fall. September and October, when inversions really exploded. The near-term forward spread inverted. The markets were saying, no, this is not going to be a slowdown. The chances of a more than mild recession are exceptionally high. And everything that has happened over the months since then have been exactly what the markets have been predicting. If you're thinking about all the things that could happen that would lead the economy into a more than mild recession, a lot of those things did happen already. And here we are in April, and the markets are saying, we aren't done yet. This is not a mild recession. This is not just a minor slowdown or a nuisance that's going to help Jay Powell get consumer prices down to where he would like them. This is something that's going to cause the Federal Reserve to completely turn around and start cutting rates rapidly like they did in 2008. And again, we see that all over the marketplace. We see that all over the monetary system, where everything that would point in the same direction of the market case continues to happen over and over again. So the Fed is getting closer and closer and closer to where the markets have been all along, because that's the way the real economy, the real market system is progressing too.
How many more Fed hikes do you think the Federal Reserve has, sort of in its chamber? I think it may be just one in May and then done.
Yeah, and I don't think the one in May is a done deal either. I think there is a split on the Federal Reserve. We saw that in the minutes too. And yes, the minutes are, you can't put too much stock in those, just like the beige book. But it was interesting how it said, and there was, of course, that Wall Street Journal article from obviously leaked sources who wanted that out there, that the Fed was very close to pausing in March. And then, yes, there are still hawks like Christopher Waller and others who are saying, no, 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 We successfully navigated the stuff in March. Inflation is still our biggest risk. The CPIs aren't down nearly as much, or the PCE deflators not down nearly as much as we'd like them. So there are those who are hawks. I mean, the hawk versus dove camps are probably as starkly different as they have been in quite some time. So I think, the hawks are going to have to make a really compelling case just for a rate hike in May. And then after that, I mean, depending on what happens, but even if nothing else happens, I think you'll see the case more and more be made that we've done enough. Now we need to pause. We need to reassess the economic consequences of everything. We need to see what's going on in the marketplace. I do think they pay attention to the markets, not just treasury bills, but other parts of the market. And I think it is, in some sense, unnerving to them. They do realize that the balance of events have moved closer to the markets than to their position. So I really think that whatever happens in May, after that, we're into the pause and then eventually the pivot.
Jeff, you for a long time have been quite a stern critic of new central bank policies such as quantitative easing in order to affect economic but non-banking economic factors such as growth and inflation. And that is a pretty severe mission creep from when the Federal Reserve started, was to stave off banking panics. What the Federal Reserve did in March of this year, where banks used its discount window, but also the newly rolled out Bank Term Funding Program, BTFP, which allowed banks to secure funding for up to 1 year, pledging their collateral at par. Talk about collateral. That seems to be relatively close to what the Federal Reserve was started to do, in 1913. How would you judge the Federal Reserve's actions? How successful were they in sort of fighting the banking panic? And yeah, what do you see going forward?
Yeah, I mean, that's in one sense, that's really what they'll tell you, is that that's their job. Is, yeah, we don't really want to manage the economy, but Congress made us. That's what Jay Powell would say, because they say, they actually have three mandates, not two. The third mandate is actually interest rates, but they never talk about it because they say if we get employment and inflation right, then interest rates will take care of themselves, which obviously that's not the case. But you're right. They would say that, we want to be a central bank, but we don't really know how to be a central bank in this modern system where money has evolved so dramatically that we can't even figure out, we can't even define what money is. And so you also hear them talk about how they've become a market of last resort rather than lender of last resort. But that's really about trying to, when we enter these periods where the monetary system and the banking system gets itself into trouble, it's about breaking the circuit between, the vicious cycle of illiquidity leading to fire sales, which leads to more illiquidity, then fire sales, and round we go. Then that harms the economy, which threatens the employment mandate and inflation mandate. So they're trying to step back from, we hope that they learned from the 2008 crisis. We know they really didn't. Understanding that there is a direct relationship between problems in the monetary system and problems in the economy. Now, Congress has mandated them do something about the economy. They're trying desperately to figure out how to do that. How do we connect problems in the monetary system with problems in the economy? How do we interrupt problems in the monetary system from becoming problems in the economy? And that's why they have to keep experimenting with all these new things like quantitative easing. Now we've got the BTFP. There's also, March 2020, they came up with something called FEMA. FEMA was actually used this past March. There was about $60 billion used there. It's down to, I think, $20 billion as of this week. So they keep constantly trying to figure out ways, how do we keep these monetary events from spilling over into the real economy? And as we keep seeing, the monetary events keep happening and they keep spilling over into the real economy. So I don't think the Federal Reserve has been all that effective at all. And it really depends. I mean, what they say is, well, we kept it from being worse, which is one of those, unfalsifiable claims that you can never prove a counterfactual anyway.
Right.
So they say, well, if we hadn't done this, it would have been so catastrophic, we'd be all back in the Stone Age. I mean, that's not really a valid argument, but it's a recognizing the fact that we still have these problems. Monetary system problems become real economy problems, and those have not changed. And I think that's what we're really talking about right here, is that we've got the monetary system problems. We've had them for quite some time, but now everybody knows that we have them because now we've had these bank failures, which have gotten people talking about banking. So we know there's monetary problems. We're sort of waiting to see if there are economic problems when the markets are saying there is going to be lots of economic problems.
And how would you estimate the cause of the fall of Silicon Valley Bank? Key to that was the very flighty deposit base, the fact that they didn't have enough capital, but really at the heart of it was these securities, treasuries, but mainly mortgage-backed securities that were parked on the held to maturity book that they were valuing still at $100, even though if they were to sell them on the market, they would have gotten severely less money than that. How much do you attribute the Federal Reserve's rate hikes to the fall of Silicon Valley Bank? Given that if interest rates were still at zero, those mortgage-backed securities would be still be quite valuable.
Yeah, I don't think that was really the issue here. That was sort of the last link in the chain of events. You got to remember what we're really talking about here is the distortions that the government really created in 2020 and 2021. That's really, I mean, Silicon Valley is probably a case study in those distortions because the government threw a bunch of cash at the economy, and one of the biggest beneficiaries of that was banks, especially regional banks, who suddenly were flooded with these deposits. And especially that the Silicon Valley Bank was flooded not with just deposits, but sitting in the middle of Silicon Valley when the stock market started to go crazy, they got flooded with even more deposits. So we had this massive one-time distortion, not just in the economy, but in the banking system too. And over the last couple of years, lo and behold, those deposits, that cash began to migrate to other parts of the economy because it wasn't being recirculated in the way it would organically. So Silicon Valley Bank made huge errors in thinking that one-time flush of that windfall of deposits a couple years ago was going to be a permanent underlying background that they could base their entire portfolios on. So as cash began to migrate, not just from Silicon Valley Bank, but regional banks in general, as customers, these startup firms that Silicon Valley Bank was lending to used more cash than they were anticipating because they were not paying off. The economy was not performing the way they thought. So the original sin here, for lack of a better term, was the 2020 distortion and then the cash migration that then triggered all of these liquidity measures, which people began to notice, which then triggered the deposit flight, which finally triggered Silicon Valley Bank saying, we're losing so many deposits, we have to sell assets, but we're going to end up selling assets that are underwater, which is the last thing anyone wants to do. Again, lessons of Bear Stearns. The more interesting question to me isn't that. It's why didn't they start pooling together loans and swapping them for collateral and borrowing funds in wholesale? Why didn't they go to the Fed's discount window? Why didn't they do a whole bunch of things that they could have done to remain in business? That's really the question here. And I think that's maybe the question that a lot of the markets are starting to ask, not just of its peers, but other banks too. What's wrong with your asset base that you can't do some of these things that banks normally would do when the environment's really good? So Silicon Valley Bank to me is a microcosm of how we're going to end up paying for all those distortions from a couple years ago. Because really all the government did was sort of kick the can down the road and make a huge mess on the way that we now have to sort of try to navigate and clean up.
You're absolutely right, Jeff, that there was a huge influx of deposits. I think they actually tripled or close to tripled at Silicon Valley Bank, which is for a bank is really ridiculous over the course of 2 years. And then the companies that were had deposits with them, many of them were venture capital fundings. What is the typical of most venture capital companies or companies funded by venture capital, early stage companies? They spend more than they make because
Cash burn. Yeah,
and
absolutely.
when interest rates are at zero and money's sloshing around the system, the founders are calling them up saying, "Hey, great quarter, but next quarter try and lose more money," because you want to grow as fast as
Yeah.
possible. I might ask you a question, a little plumbing question, which is, do you think that quantitative easing had something to do with the influx of deposits? The central bank, and I know this, and I want to say for the audience as a fact, the Federal Reserve does not print deposits; they print reserves, which are the assets of commercial banks, the liability of the Fed. Commercial banks print deposits, which are the liabilities of commercial banks, the assets of companies and individuals. However, you look at that March 2020 chart of the Fed's balance sheet and then M2. When people talk about money supply and you see a chart on Twitter for people listening, it's probably M2. Do seem pretty correlated.
Yeah, the one time they were, right?
Yeah.
Because they're not really correlated all that much. Like you said, The quantitative easing to me, no, that it really didn't play much of a role. That's more of an accounting issue than anything. And it's really the issue with M2 and the Federal Reserve Bank reserves, as we talked about earlier, is that they're a narrow form of money, and it's really what happens in response to it. So the question is, did quantitative easing trigger the deposit creation, or was it the federal government's, the federal government's essentially helicopter payments? And I
Mhm.
think that was the more effective, the more blameworthy distortion here is that the federal government got involved in the monetary system and the economy for reasons that had nothing to do with pure economics. I mean, small e economics.
And Jeff, was that money printing by the fiscal government helicopter? Was that money printing?
I wouldn't consider it money printing. I consider it redistribution. So the federal government borrowed funds from the Treasury market. Maybe banks created money on their own to pay for those treasuries, but essentially it was a redistribution because that's what the federal government really does.
But the Fed bought a lot of those treasuries. So yeah, the government, AKA the Treasury, they borrowed from J.P. Morgan. They issued bills bought by J.P. Morgan, but the Federal Reserve bought those treasuries.
Some of them, yes.
Yeah, yeah.
To me, that's an unimportant distinction because whether the Fed bought them or not, I think they would have been issued either way. So where they ended up, who actually owned them out once they were created, that to me that's just academic because they were going to be created anyway. So then once that happened, the government does what it always does, which is redistribute for all the worst reasons. And in this case, they just threw as much cash as they could at the system, hoping that it wouldn't, hoping it would help for the economy that was completely shut down. But there's arguments to be made about that, whether there's a moral case or whatever else. But what we do know happened is it was a huge distortion, and a huge distortion that didn't just go away. And as you said with Silicon Valley Bank, Silicon Valley Bank got hit with this huge windfall of deposits. And yes, they realized that, their customers were going to run through this cash. There's a significant cash burn. But what they were expecting is that new cash would come in from stock IPOs and other things that would replace old cash these companies were running through. So essentially, they fooled themselves into believing this one-time distortion represented a permanent shift in their business fortunes. And so Silicon Valley Bank is not unique in that perspective. Lots of other banks, as well as businesses, saw this massive distortion and said, this is permanent. This is a new permanent plateau of prosperity for me and all the people that I can see. And they started acting as if that was the case when it wasn't the case. And over the last year and a half or so, we're starting to see reality intrude, which is then interrupting all of these dreams and hopes and really bad ideas and forcing a reckoning for a system that needs to come to terms with that massive distortion from a couple of years ago. You can't just throw everything like that out of whack and just expect everything to go fine.
Did the banks take too much interest rate risk in 2020, 2021, buying all these mortgage-backed securities and stuff like that?
Yeah, I mean, there's an argument to be made for that because, but then again, what else were they going to do? I mean, at the time, that's what the market offered. And really, I don't think there's a whole lot of risk to those either because you just put them in your bank book and hold them to maturity. And yes, you don't get as much a return. Your net interest margin suffers, those kinds of things. It's not great for you to be a bank, but it doesn't put you out of business. There's nothing wrong with holding a U.S. Treasury to maturity. It's when you're forced to sell it that's when the issue becomes real. Is when you take a security that's underwater for any reason. Doesn't really matter what it is, and the market doesn't care. The market's ruthless. If you're selling a security that's underwater for any reason, creating a loss on your balance sheet or in your income statement that goes to the balance sheet as erosion in capital, that creates a problem for you. And so the issue is not the security you're selling, it's why are you being forced to sell the security? You're not managing your liabilities and liquidity, that you're leaving yourself exposed. And to me, that's the more interesting part of Silicon Valley Bank, not what they sold, but why they felt they had to sell it. And of course, we know, yes, it was the obvious answer is the deposit flight, but why didn't they take advantage of all the wholesale opportunities that they could have had or should have had to at least, stem the tide of their, avoid the worst case scenario of selling their assets? And one of the answers could be they were just that bad at being bank managers. They sold these assets not realizing it was their own death warrant. That could have been the issue here. But I think there's more at play here than that. And I think there are more banks out there that are worried that are saying, I don't want to have to sell these securities because if I do, it's going to just trigger a worse deposit flight. So they're building up their cash cushions, they're de-risking, they're doing all the other things that Silicon Valley Bank should have done and probably wished it would have done ahead of time. And that's really we get into the pro-cyclical stuff and the credit crunch.
Right. Yeah. So on the credit crunch, I've seen you use the term deflationary money. What do you mean by that? Do we have deflationary money now? Did we have deflationary money in last year in 2022? With the caveat that consumer prices rose dramatically, which people call inflation. And there's monetary inflation, which my I guess informal definition, maybe I'm wrong, correct me, is bank credit. So bank making lots of loans. I think bank credit did expand in 2022. It may not going forward. We'll see. Yeah. So how do you define deflationary money? Did we have it in 2022? Do we have it now? Will we have it more in the future?
Yeah, we think about, to me, deflationary money is interruption in the circulation of money and credit. It's not about the stock, it's about the circulation. Because you can have all the money in the world, like in the early 1930s, there was tons of gold, it just didn't move. And because it didn't move, it's not being used, the economy just fell apart. And that led to deflationary economy, which is falling consumer and wholesale and producer and every other sort of real economy prices. So to me, deflationary money is something that impedes or interrupts the circulation of money and credit that eventually might lead to, if it's allowed to go too far, all of those nasty consequences in the real economy. As we said before, what the Fed is trying to do, stop deflationary money from spilling over into the real economy that then becomes what I think most people associate with deflation, which is falling consumer prices. So deflationary money is a monetary problem that, if left unchecked, will lead to deflation in the real economy in the most extreme cases. Now, what is deflationary money? Again, if it's an interruption in the circulation, it doesn't necessarily have to be a contraction. It doesn't necessarily have to be a complete lockdown or a complete shutdown of the system. It could just be something that is causing it to not circulate enough money and credit given a level of demand. So if demand for money and credit is up here, but the circulation and supply is down here, you could have deflationary money, even though it's expanding, because you're leading to all sorts of problems where we have to compete for credit and money. The price goes up. There's distortions in that respect. Heightened demand for collateral above and beyond what there should be, which causes all sorts of problems. So in 2022, even though lending went up, I don't think it went up as much as the nominally inflationary economy. I don't think it was inflation, but the nominally growing economy actually needed for it to continue to grow. So it was modestly deflationary last year. And I think this year it's becoming even more deflationary, where we're seeing major interruptions in the circulation of money and flow of credit. Of course, that's what we've been talking about for the last hour, right, Jack? Is
Yeah.
all of those types of situations. So modestly deflationary money, which caused the markets to say, oh boy, there's trouble up ahead here. And that's why we saw the inversions, because modestly deflationary money was interpreted as next year could be really bad, or even this year. So sometimes it could really lead to some really high probable nasty scenarios. So yeah, I think we had deflationary money last year, and I think we have a little bit more of it this year, and hopefully we can avoid the worst of it the rest of this year into next year. But you look at the way the markets are trading, it's we're still looking at the same type of situation.
And when you say the markets are trading, you're primarily talking about short-term interest rate spreads, inversions, stuff like that.
Yeah, again, the all the symptoms of Bear Stearns that you would see in a yield curve or a money curve, where you don't want to see them inverted at all. But it's even today they're just epic levels of inversion, stuff that we didn't even see in 2007 and 2008. There is a lot of there's a lot of I wouldn't call it uncertainty. There's a lot of almost near certainty about the fact that at some point, we still don't know when. Timing is always the issue, but at some point, money, the monetary deflation spills over into the real economy, and it just leads to all the bad consequences. So the markets are as sure today as they were before mid-March that these things are going to continue to happen.
And you said we're seeing things now that we didn't see in 2007, 2008. What would be an example of that?
For example, in Eurodollar futures, which is a curve that I always look at, you look at some of the moves last month. I think it was March 15th. I want to say the 15th. You saw a just massive swing in hedges, so that the yield curve, the Eurodollar curve inversions, which were already extreme, became even more extreme. Some of those spreads got to be so enormous that we didn't even see those types of extremes in 2007, leading up to what became the global monetary crisis. So in March, in last month, we had the curve moves, contract moves, price moves, distortions, upsets, inversions, that just historic level stuff.
Yeah, right. And I think I saw that. Yeah, March 10th was Silicon Valley Bank failed, and the week after that, very strange things going on in the bond market that indicated market stress and people having to unwind position. I think the sort of betting that rates would just go super high. That was a crowded trade that had to be unwound very quickly, and then it sort of cascaded. When you say Eurodollar futures, Jeff, so there's a Eurodollar system on which you are an expert, and people should check out your work and your YouTube channel, your Eurodollar University, the offshore dollar system, and that is different than Eurodollar futures, which are bets on the future of LIBOR, London Bank, that's sort of the rates there. Isn't it true that LIBOR is in the process of being phased out and that those futures won't be trading soon?
No, they're going to continue to trade, but they'll be trading on term SOFR. They've already made up the adjustment factor, and so on June 30th, when they stop pricing LIBOR, when the Intercontinental Exchange does, they'll just be based on term SOFR. So they'll kind of roll over at that point, and then the Eurodollar futures will just become SOFR futures essentially.
Mm.
But that's a good distinction. The Eurodollar system doesn't care. The Eurodollar system is still there. The Eurodollar futures were just a way to price systemic conditions in the Eurodollar system. So what the government has said is, we don't want to use LIBOR to price systemic conditions in the Eurodollar system. We're going to use this other benchmark. So we're changing the benchmark, which I think is a real big mistake. But either way, we're changing the benchmark with how we monitor conditions and stresses and strains and prices, fundamental prices in this Eurodollar system that is going to continue operating for the foreseeable future, unfortunately.
Mm. Thanks, Jeff. I want to propose a counter theory, a theory about, actually, the inversion and the huge preference for short-term treasuries, 1 month treasuries over term equivalent, is not indicated of, we're at a Bear Stearns moment. There's going to be a coming credit crunch, of actually about the debt ceiling. So there will become a day at which the Treasury will, and as people can tell, I'm not an expert on this, but the Treasury will run out of money and Congress will have to raise the debt ceiling. And if it doesn't do that, people who own treasuries are at the risk of uh, not being paid, but not being they'll have to wait, to be paid. So it's a lot of uncertainty. So so the theory goes, and again, I'm not doing a good job of articulating it. I should cover it more on this channel. The theory goes that there's a preference for paper, for treasuries, that will mature before that happens. So that is why, and I guess, in other words, if there wasn't a debt ceiling, the whole curve would be trading like the 1 month. I guess that's the thing. What do you say about that theory?
Yeah, it doesn't make any sense to me because we've been through these debt ceilings before, and that's not the way the market reacts to it. What really happens is, really the only participants who are worried about the debt ceiling are money market funds, because a money market fund has a fiduciary responsibility not to break the buck. And we saw the consequences of what that happens, what happens when that happens many years ago. So money market funds will look at their portfolio. If they have any treasury bills that look like they might mature around where the debt ceiling gets breached, they'll sell them. They'll get out of those treasury bills because they'll say, I can't own those treasury bills on the infinitesimally small chance that something does happen. Not even a default, as you said, Jack. Maybe the Treasury has to delay a payment. That could be catastrophic for a money market fund. So money market funds are understandably careful about the debt ceiling. So what they'll do is they'll preference bills that are either shorter term in nature, that will mature before the debt ceiling is, or before the Treasury is projected around of cash. They'll also buy longer dated bills when it's projected to be very likely that the debt ceiling will be raised, because we all know it will be. This is all just a political farce. It's really stupid anyway. So there's really just an issue about that narrow window where there's some uncertainty there. But that doesn't lead to this massive drop in bill yields. We saw this happen in 2011. 2011 was a perfect example because we had the same types of conditions. Not only did we have the debt ceiling, which was an even bigger problem in 2011. Remember, 2011 was one of the biggest, it was one of the most consequential games of debt ceiling chicken we've ever seen. In fact, it led to the downgrade in the U.S. debt. At the same time, though, before all that happened, we had all sorts of collateral problems. They called it the European debt crisis, but it was really a collateral shortage. And in the early months of 2011, really around April into May, we saw Treasury bill prices fall. They didn't have far to go at that time because everything was close to zero. But in some cases, the 4-week Treasury bill rate was right at zero, and some of them were probably negative along the way. So massive demand for collateral before we ever got to the debt ceiling. And then when we got to July, when the debt ceiling got to be a big problem, what did you see? You saw Treasury bill yields suddenly spike, because then it was like, oh my God, maybe this debt ceiling won't be resolved in the way we think it was. So in the week leading up to July 29th is when the agreement was announced, when the agreement was reached and announced, even 4-week Treasury bill yields jumped up to about, I think, 16 or 17 basis points. So you see, the demand for bills ahead of the debt ceiling had nothing to do with the debt ceiling. And then when the debt ceiling becomes most uncertain, you'll see bill yields rise, not fall. And then as soon as the debt ceiling agreement was reached in July 29th, by August, I think it was 1st, bill yields went right back down to where they were beforehand. So to me, there is nothing except for one little thing. There's nothing in the debt ceiling what we're seeing in the Treasury bills. The one thing that we might be seeing is that the Treasury Department, in order to get ready for the debt ceiling, because they can't just say that it's going to be raised, they have to take measures ahead of time. They are cutting back on the supply of Treasury bills. The 4-week and 8-week auction, the 4-week auction that was conducted just yesterday, they only sold 50 billion instead of the 60 billion the week before. So they're constraining supply, which obviously doesn't help with prices. But it doesn't explain the fact that the yields and the demand for bills is just through the roof. So the debt ceiling stuff, the lack of supply, even that is probably not that much of a factor, because the late December into January, there was only 45 billion in bills. So they were selling fewer bills last year, and we didn't see those extreme amounts of price swings, didn't see these extreme levels of demand. So I don't know. I don't see the debt ceiling as even a small part of what we're seeing in the bill market. It's one of those things where you would think that if money market funds had the ability to go in the reverse repo, they would just avoid bills, and therefore it'd be less demand for them. So the rates would rise as they have in other debt ceiling period. I mean, think back to October of 2013, to a lesser extent in September of 2017. That's what you see when you get to these debt ceiling periods. Bill yields jump, and then demand for bills is really independent of the debt ceiling issue.
Makes sense. Definitely over my head. Well, Jeff, people should check you out on Eurodollar University, your YouTube page, Eurodollar University, and on Twitter. As folks can see, you post regularly at Jeff Snider _AIP. Jeff, if you could just summarize, in a minute or so, your views on what the yield curve signals about a potential credit crunch and deflationary money.
In just very simple terms, what the yield curve inversion has always implied, because it's, you look at Eurodollar futures, for example, because it's tied to 3-month LIBOR, it's basically a reflection of where money rates are going to be in the future, which that has a heavy component of what the Federal Reserve policy is going to be. So in very simple terms, the market was betting more and more strenuously that something was going to happen, or several somethings were going to happen that would force rates to go lower, whether the Federal Reserve wants them to go lower or not. And that really, the more the more hawkish the Fed became, the more it talked about its reaction function solely in the context of inflation and consumer prices. That meant that it would have to be an even bigger something to turn the Fed around. And as time progressed, the markets became even more certain, didn't matter what consumer prices were doing at any given moment in time, that something or combinations of something would happen. And as I said before, we continue to see all the reasons why that would be continue to pile up. So where the markets are now are saying that we are almost certain that rate cuts are going to start in the near future, and that the second half of this year will contain a rapid series of rate cuts. And so we have to backfill in our minds what that would be. What is it that would cause the Federal Reserve to start rapidly cutting rates when they're saying we have no intention of cutting rates at all in the near future for anything? And that really gets us into exactly what we've been talking about here. you've got an economy that's shaky, maybe moving into a mild recession as the Federal Reserve admits, and you pile onto that a credit crunch and a bunch of liquidity problems, that would get you into exactly what the markets are preparing for.
There we go. Jeff, thanks so much for sharing your insights, and thanks everyone for watching.
Yeah, thanks, Jackson. Great to see you again.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Check out today's sponsor, public.com, at public.com/forwardguidance. That's public.com/forwardguidance. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.